So the euro, the British pound, and the Japanese yen, all against the US dollar, are moving in the same direction today. However, the fundamentals are saying a quite different story. So in this video, we're going to be looking at these details and understand what is really happening fundamentally and if this move is real or fake. No calls, just pure analysis, you decide. So looking at these three pairs of the fundamental charts, what we have here is a detailed fundamental review. We're going to start with the euro US dollar, then we'll dive into the US dollar JPY, and then the British pound against the US dollar. Starting off with the euro against the US dollar, we have actually a neutral stance. Regardless of what the chart is showing you, this is just what the fundamental is saying. How does it mean? So the high impact news data all released are all aggregating to a neutral stance of 51%. If you're new to the channel, 100% means extremely bullish and 0% means extremely bearish. So at 50, you are in the neutral situations. In the recent 14 days, all news release has been around the 49.42% mark, which is also somewhat neutral towards the bearish side of the market. However, the technical directions of the daily chart is kind of bullish. It's been bullish for a while, still bullish today, and it's a good one. But this is where you need to become very, very careful. The non-commercial traders, now these are traders who trade purely for profit, are actually not long in this market. Now, when you say the non-commercial traders are not long, it doesn't mean that they are trading the US dollar, the euro against the British pound market. No, they are not trading that. Instead, what this means is the amount of long in the US dollar compared to the amount of long in the euro. When you do that comparison, you realize that there's more longs in the US dollar than there is in the euro. Now, the commercial traders, these are the risk takers, the guys who are actually being hedging against risk. They are somewhat in the neutral space. Matter of fact, somewhat in the bearish neutral space for that matter. So you can see that a lot of things in this market are running against the technical directions of the market, and this brings my calculator to tell me this market is most likely neutral. So now, with all of this, looking at that, let's take a look at it in some small nuance and details. We're going to take a look at the actual COT data and see what the euro against the US dollar is really doing. So looking at the COT data specifically, we're going to look out for just the euro and the US dollar in this case. And what you can see here is that clearly the red is for the non-commercial shorts and the blue is for the non-commercial longs. And what you can see here clearly is that there are more longs on the US dollar than there is on the euro. Looking at it down here on the table, what we have on the table here says that if you look at the non-commercial trader sentiment, we have 11.38% long. And the change is, yes, they increased their long position, but they also reduced a lot more of their short position. However, when you look at the total positions available, you can see that the total contract still leans heavily bearish, more into shorting the euro than buying it. While for the dollar, they are still in similar situation, but when you compare that weight in terms of percentages, you'd see that it comes out to 25.06%. When you compare that against the euro, you can see clearly that there's more belief in the US dollar gaining strength than the euro gaining strength over time. Now, let's take a look at the fundamental data of this market. Let's see where all of this fundamental situation is coming from, the high impact and the 14 days impact. Taking a look at that, we can see that by currency score, we have the euro against the US dollar. So what we see here is that the euro against the US dollar, it's both neutral. However, on the overall data, the data for the US dollar is much more neutral than the euro. The euro is leaning slightly positive, but in the recent 14 days, the US dollar seems to be leaning a little bit against the euro. So, and then looking at the sentiment data, just like we looked at before, you can see that it's 11% for the euro and 25% for the dollar. If you want to go more depth into this, so looking into that data, we can see, looking at the euro, this is the euro right here, we can see that the central bank data has been flatlined I mean, we've finally gotten used to the current situation of the central bank, so it's not really going to be pushing the market, but it is still pushing the market, right? But the economic data releases for the euro is been good. The employment and inflation data is just mild. While for the US dollar, we have flatlined central bank data. The economic activity is flatlined towards the negative side. However, the employment data has been real good, and the inflation data is not so good. Now, this is where the US dollar is really losing its mark in. If they had been neutral here, then they would definitely be the stronger counterpart. Why is this so? Well, just for a little bit of detail, this four data here, this four key metric here determines mostly what any trader should be looking for in the market. Does the economic activity of that environment look good? For example, are they good economic activities? Are people buying? Are retailers or retail participant buying? Meaning individuals like you and I, are we buying things in the market? Are we participating in the market? Are we, now when I say the market, I don't mean the trading market. I mean the actual market of things like buying of products, buying of goods and services, paying for goods and services. Is it going well? That's what economic activity stands for. Employment data has to do with the job data, the unemployment data, and the employment data. Things like your minimum wage, your average wage, the earnings, the capacity of the country, and all that stuff. Is it going good? Is it really going good? And then the inflation data has to do with CPI. Are things eroding your income so fast? And you can see what's happening here is that the inflation in the US dollar, in the US economy, is seriously a big problem. Even though they have gotten like good employment in their recent sets of data, however, the fact that there's inflation makes it quite sticky for them to navigate. Now let's take this all into the chart. Now, being that I'm supposed to be neutral on this chart, I'm just going to tell you guys straight up that when I see this daily candle pushing upwards to the upside, I don't feel like I am losing anything. Honestly speaking, I don't feel like I'm in loss. I don't feel like I'm in loss at all. This push up to me is just, I'll call it a lot of retail traders working in the market as it is. That's what it really tells me. However, if I put up my own indicator, because I have a personal indicator on this chart, and I start to look out for supply and demand zones and possible directions that the market could most likely go, what I see here is this market is still in a bullish run. This is the 200 moving average daily. And when I look into the 4 hours, mind you, the 200 moving average is locked. I don't change it. It's locked to that particular time. And I start to look into the market. I see a technical setup for a possible buying situation. However, this is what I do personally. I don't just look at what my indicator is showing and what I think the market is doing. I'm looking at what really is happening over that period of time. So you can see I turn off the indicator from time to time. On the daily, what do we have here? We last saw price broke below this evident low right here. Very clear low, good break, and that was quite obvious. That was a break of structure, most possibly something a lot of people will call change of character at this point, right? At this point, it's most likely a change of character. But another thing you also need to pay attention is this. If you look way back into this direction, you will notice that price for the US dollar and the euro, take a good look at this range, right? I'm going to put my mouse all the way from here to here and down to this point. You can see that this market has been range bound for a long time. It's not easy to see when you're looking at it at the daily chart and you're just looking at the recent charts, right? But if you look at it just like this, you can actually spot it. If you want to spot it even easier, just go to the monthly chart. And what you'll notice is every single move we've made ever since around July 2025 has been range bound, basically range bound. These are position traders, their portfolio is just stagnant in that case. For swing traders, they've had some good ups, some good downs, but not like the usual Euro US dollar good ups and good downs. And what does that mean? This market is still quite sticky to predict a good direction for. So like I said, it's your choice to make a direction, it's your choice to choose. But in my opinion, just giving you the breakdown of the chart, I'm just going to show you all of this on the chart. First and foremost, let's pay attention to the possible places that will make this market look bearish or bullish. A break above this high, a break above the 1.2081 levels, is that this market is now fully in a bullish move, like absolutely completely bullish to both positional traders and swing traders, no doubt. For swing traders and day traders, now you see the way I'm demarcating it. Swing traders and day traders, this is what they are looking at. We have had the break above this. This is on its own a short time choke. Now, not that it is a big break of structure or a change of character. It is a short time change of character, and this means price should be aiming for upsides such as the 1.18 levels, which price has actually mitigated and taken, and then they should be expecting things like the 1.192 levels, which price seems like it's kind of going for. So on the lower time frame for swing traders, this is the lower time frame for swing traders, we've had that change of character again, as you can see right here, when price finally broke above this level right here. So this right here was our change of character. Why is this a change of character again? Well, we had a break of structure to the downside, and we had a break of structure to the upside, breaking the last lower high, and you can see that brings the pattern of a change of character on its own. So you can see this is a change of character, and price comes back and even tries to continue the run to the upside. Now this last break here, people would say it's not a break, but price has gone above this already, and price is still finding it difficult to stay above this zone. As you can see right here, price is finding it difficult to stay above the 1.178 zones, and when you see price finally make its way above those zones, one thing is becoming quite clear, right? It's becoming quite clear that the market is now moving in a short-term uptrend direction. So the least resistance to this market to me is that this market is actually neutral. That's number one. And secondly is that it's neutral in a slightly bullish sense. However, I am more in tune to looking out for price, taking out levels such as the 1.8 levels, 1.84 levels. If price goes above the 1.84 levels, as you can see, both levels here are around the 1.83, 1.84 levels. If price could go above the 1.84 levels, then I would say this market is clearly bullish. I just need to see first and foremost a clear close above this place before I say this market is towards the bullish side. Now let's move on to the next market. Now let's head into the data of the US dollar against the Japanese yen. Being that we already know what the US dollar's impact data already looks like, let's take a look at that and compare it against the Japanese yen. And this is where a lot of people got burnt, I think a week ago or 2 weeks ago. When you look at the economic data, the real intricate economic data, what we see here is that the Japanese yen has, obviously we have gotten used to central bank data for all markets. However, the economic activity for Japanese yen is really good. It's good, as well as their inflation data is good. The only problem they have is the employment data. Now, mind you, it means the people who are employed are making enough money that they could participate in the economy, and they could participate so well because the inflation is not even bad. So those people's participation is quite more than enough to muzzle out the unemployment situation, even though they have like really terrible unemployment situation. But when you compare that against the US dollar, where there's good employment but not enough money for even the employed people to spend because the economy is eroding those employment cash, then I think you should clearly say to yourself that the Japanese yen is a little bit stronger than the US dollar at this point in time. And if you look up here, the overall score, now mind you, if you're looking at that with the eyes of one to one, you're wrong, right? It's a weighted calculation, because the economic data and inflation data is straight up better than that of the US dollar. You just don't dive in and say it's best, right? They are weighted situation. Sorry, the data for employment tends to have more weight than data for economic activity, because employment is what leads to economic activity. Economic activity is what leads to inflation. So mind you, this is the weight pattern. The central bank has the best weight, followed by the employment data, and then the economic data, and then the inflation data. So if you notice what happened here, The overall impact score has the USD gaining more strength at 50.8% compared to the Japanese yen at 48.2%, even though the Japanese yen had more green data. This is because the US dollar is winning in the place that has the most weight, which is the employment data, and they are winning by a large mile. If the Japanese yen had like 10 or even 20%, they would definitely either catch up or supersede the US dollar. Now put that in mind and let's move into the COT data. In the COT data, and looking at the Japanese yen against the US dollar, you can see that the mentality I looked at the market with is what the non-commercial traders, these are the traders who are trading for profit, the hedge fund men, they're trading for profit, purely profit traders, right? They are looking at this market and take a look at what they did with their contracts, right? Take a look at what they did with their contracts. They have much more long contracts than they have short contracts. But the recent changes, now this is how you should also observe, be very careful, right? The recent changes is saying they majorly decreased their Japanese long contracts. So they stepped down on the pedal. They reduced their foot on the pedal when it comes to the Japanese long contract, and they started adding more shorts. Now, over a period of time, this is most likely going to turn bearish as compared to the US dollar, where they added some longs, but they are still net short. But if you look at this again, the data is saying that currently they still believe more in the Japanese yen than they believe in the US dollar. And this is not me saying it, this is the data right in front of you saying it. With that in your mind, we're going to now go back to the table and see what the table is saying when it comes to the US dollar against the yen pair. So this is the US dollar against the yen alone. We're just going to go look into it, and you can see that the market, the view for this market is actually bearish. Again, the data overall is neutral, somewhat neutral towards the bullish side. In the recent 14 days, all news coming out is towards the bullish side. Now, for those of you who were on those charts last week, obviously some people got burnt. The chart is absolutely bearish, and even the commercial traders, the non-commercial traders, sorry, are still having more bearish sentiment in this market than they are bullish. Now, put that all together, let's look into the chart. And my dear friends, just by looking at this chart, if you were in this market on Thursday, 30th April 2026, you definitely saw that heavy move to the downside. As we all know, the Japanese, the Bank of Japan is strongly against the yen at 160 to the dollar. They are strongly against it. They are trying to save their economy, and it's not a wrong thing. Even with everything anybody is doing, they will definitely come into this market if it should go beyond those points. Again, looking at what the chart is saying is what retail traders like us are going to trade, right? The chart is saying overall, this chart is actually a bullish market. As you can see in the recent 200 days, price is well above the recent 200 days. Price is even bouncing off the recent 200 days and seems to be finding support around those levels. However, I can't trade this market even bullish or bearish. Why? For me to trade this market as a bearish market, it has to totally nullify this entire demand zone. That is, it needs to start going beyond the 1-2 mark for me to even start seeing this market as something I want to call short into. But those of you who are out there trading the market, you make your choice yourself, right? If it's fair enough for you to take a trade, take a trade. But on the daily, I need price to go below the 152 for me to say this market is somewhere I want to start shorting into. And then for the 4 hours, what I see here is we are still living off the hell from the 30th of April. You can see that all the shorts came down, and lots of buy trade seems to still come into this market. Lots of buying trade. You can see lots and lots of wicks at the bottom of the chart. However, the move to the upside is quite struggling. Like you can see clearly, it's taking such a struggle to move to the upside, and then when it's coming to the downside, you can see how instantaneous, how almost instantaneous that is. Like boom, struggles to the upside, boom, struggles to the upside. I'm seeing a tendency of another heavy drop over a short period of time if care is not taken. But again, This is your choice. You could make a choice in this market. Now, finally, we have the last market, but not the least, the British pound against the US dollar. Like we did before, we're going to start with the fundamentals. So for the British pound against the US dollar, what has been happening? Well, the British pound overall has more strength than the US dollar, even though they are both neutral. In the recent 14 days, the British pound had more good news than the US dollar. Clearly, it is bullish in the recent 14 days. But we're looking at the sentiment, the COT data, right? The COT data. What do we see? We see that the non-commercial traders are heavily long on the British pound for sure. So now, just from this angle, it's clearly saying, let's go long this market, right? Let's go bullish in this market. That is what it is saying. But again, we're going to have to look into the in-depth of this data. We just don't take it off for what it is. We're going to have to go in there and ask ourselves, why is it happening, or what in particular, what data is making this push seem so obvious to the COT traders, the commitment of traders, the hedge fund traders, that is not so obvious to you, the retail traders. Now, moving into the all currency page, what we see here is that the British pound has had really good economic activity. They've had not so good employment data, which is supposed to be their winning mark. But then again, they've had just above inflation data, which is something I was saying. If the Japanese yen had even a flint good of, not really good, but just a movement in the employment side, they would be better than the US dollar for sure. But in this case, you can see that the British pound is clearly embodying that situation. It's embodying that situation, and it's already showing in its score at 55% compared to 50%. Looking at the COT data, let's see what the COT report for last week says. We're gonna just go straight for just the. I don't want to waste our time. Let's head for the euro, the British pound, and the dollar. And you can see right here, clearly, you don't need anybody to tell you anything about this whole situation. You can clearly see it from the charts. But looking at the details itself, you see that the non-commercial data is against the non-commercial long against the non-commercial short. And you can see the non-commercial sentiment saying 71.1%. That is a high percentage into the bullish side. And the change, what did they did? They even removed a lot more short contracts on the British pound. This tells you one thing. There's much more belief that the British pound has strength than there is a belief for the US dollar in this situation. Now, putting that in mind, let's go look at the clear impact table. I don't even need to go far. Why? Because on my table, that is actually the best thing on the table right now. I have the British pound US dollar in the slightly bullish range of 65.8% aggregate. And where is this aggregate coming from? It's coming from the fact that I have 51%, basically 52% of the high impact data. That is all data releases. I've been having slightly bullish 14 days releases. In the daily direction has been absolutely to the upside. The non-commercial data, well, the hedge fund traders, the guys who are looking for the maximum profit, are also longing this market. As you can see, almost everything here is hoping for a long side, except the commercial traders, the risk hedgers, the guys who are trying to hedge the risk of the market. They are the ones shorting this market. And with all of that in mind, this market is a slightly bullish, or if not even already fully bullish market. Now let's take a look at what that gives us in the chart. Now on the chart, we have a market that is clearly above the 200-day moving average, and it's heading straight for a supply zone, as you can see right here, the 1.38 supply zones. And you can see right here that this market is not like the US dollar JPY, nor is it like the euro against the US dollar. You can see that the bullish candle for today is strongly doing. I personally, I was even waiting that I was hoping the market would give me a little push to the downside into this existing zones before it moves off, even though price had gone into the zone multiple times, right? And then if you look at this same market on the 4 hours, what I see here is price just keeps doing the same miracle, right? It keeps doing the same miracle. It's performing over and over again. The supply zones on the 4 hours are being disrespected, and we see price making more move for the upside in this market. Really good upside move in this market, and I kind of see this market continuing to the upside for a long time. It's going to like probably go up a little bit, come back down, up again, come back down, unless again, there's always situations, right? Unless something happens in real life and fundamental data and the whole market comes crumbling to the downside, you know, it's also possible, right? It's also possible. But what we're doing is we're following the current situation of the market, and the current situation of this particular market is telling us safe to buy. You could stay in for a period of time for some run, and you could walk out of the market whenever you feel like. So this is all for the euro, the British pound against the US dollar, the US dollar against the Japanese yen, as well as the euro against the US dollar today. See you all in the next one. Peace.